welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Datia. We have with us Hans Goeti, founder and CEO at H3 Research, joining in. Welcome to the show, Hans, and a pleasure to always speak to you and get insights from you.
Thanks for having me.
Absolutely. Always a pleasure. Hans, my first question coming to you right now is the most pressing thing that everyone is looking at is what's happening with Ukraine and Russia. The kind of impact that it's having in terms of global markets, equity, commodities, debt, everything put together, not something that anyone really imagined. But how are you actually looking at this geopolitical tension right now and its impact?
Well, we have seen the impact. Clearly, we've seen now or seeing a full-scale invasion of Ukraine by Russia, and obviously risky assets have sold off, equity markets have sold off, gold has gone up, exactly what you would expect. I mean, you will probably see higher gold prices, maybe oil spiking, at least in the near term, gas prices, anything commodity related should do well. And on the other hand, risky assets, we have seen sold off. We may have an opportunity in certain currencies like the dollar, the yen, maybe the Swiss franc. So in general, there is a movement and a flight to safe havens at this point.
Right. So with this, currently a couple of things that we were looking at. One was with regards to how COVID would have had its impact on the economic growth. Two, majority of the countries were eyeing high levels of inflation, and the major concern was how to tame inflation. And now you have the geopolitical crisis that have come in. Now, taking first stance with regards to US and Russia as well, do you think there is any likelihood of US to block Russia oil sales if Putin invades? Because clearly inflation becomes a concern there.
Well, see, what we have seen is that in the past that sanctions generally don't work. I mean, you can do whatever you want with oil, but there will still be oil on the market. What is underreported at this point is that the US-Iranian nuclear deal could be imminent, a new deal being made. And my sources tell me that Iran is already or has already loaded hundreds of millions of barrels of oil on tankers. So that could be supply coming from Iran. If that deal is signed, Iran could produce 1.3 million barrels of oil per day. So that's something would help on the supply side. I don't believe that oil will go to $200 just because of what's happening in the Ukraine. What is more pressing is for Europe. Europe is dependent on gas supplies from Russia. And part of the sanctions was to tank this Nord Stream 2 pipeline that goes through the Baltic Sea to Germany. Now, I'm not sure whether Europe is doing itself a favor by imposing sanctions on gas supplies to Europe, given the fact that Europe is facing an energy crisis over the next few years. As you know, they have decided to get out of nuclear power. They want to do more renewables. And of course, it does not add up. So they will still be dependent on Russian gas deliveries in the long run. So I'm not sure whether this strategy works, but I'm not too worried about the oil price going to astronomical levels at this point.
Right. So overall, right now, if you have to look at equity markets, we are seeing US plunge, Europe plunge, developing economies as well, like India, are seeing a major erosion of wealth that's happening. How would you advise an investor to view this? Do you think this should be taken as an opportunity to, start building your portfolio? Or do you think this should be taken as an opportunity to sit, wait, watch, and then play your cards?
I would not jump in head on right now. I mean, Ukraine is only one part of the equation. The other one is the Fed. The Fed interest rate hikes are a done deal. I mean, it will start in March. The question is, will it be 25? Will it be 50 basis points? We lean towards 25 basis points in order to, at least be seen doing something against high inflation. But I think it's too early to go back into equities. The technical situation is not looking good. I mean, if US equities are still overvalued despite the recent sell-off. So we are not quite there yet. So at the moment, it's better to hold more cash. And if you have to be in equities, at least be in groups that will benefit from a weakening economy. I mean, if the US raises interest rates, so they tighten fiscal monetary policy, at the same time, fiscal policy will not be as expansionary as it was last year either. So that's going to fall away. So what we're looking at is the risk of a recession in the second half of the year in the United States. And that means that's not discounted in stocks yet. So that's why I'm saying it's probably better to wait a little bit, hide in US Treasuries, and look at keeping as much cash as you can. So I think at the moment, we're looking at the prospect of a relatively sharp sell-off.
Right. So if we're expected to see a further sell-off, in fact, S&P itself is officially in correction mode as we speak right now. With everything said and done, how major a concern will inflation then be? I understand that we could be looking at a recession in the second half, but do you think this is the best way for US to start increasing rates? And that is something which will then, help them tame down inflation, one. Or two, do you think this is pretty much still a knee-jerk reaction at this time, wherein there is a possibility like last time where US will have to unwind its actions?
Well, I mean, the tightening of policy comes very late in the cycle. I mean, we're 80% through an economic expansion. The yield curve is extremely flat. So 1 or 2 rate hikes and the yield curve inverts. Could put us into a recession. But one word to inflation. The inflation that we're seeing now is the result of the pandemic. It's supply side induced. So it has nothing to do with demand. So if the Fed raises interest rates, what they do, they kill off demand. So in order to bring inflation down, and that's what I'm saying, that it's a risky strategy because we could be looking at the recession in the US in the second half. And therefore, I think that tightening policy here is probably, from a timing perspective, pretty bad. So you cannot get inflation that is supply side induced under control by increasing interest rates. Supply side induced inflation, there's no response any central bank can come up with without killing off demand and killing off economic growth. So in that sense, there is room here for a policy error by the Fed.
Right. So overall, currently as well, which are the sectors that you would be favoring in developed markets, and which are the sectors that you would be favoring in developing markets?
I think in developed markets, what you want to be in are defensive sectors that will do relatively well in an economic environment which is characterized by a slowdown. That includes utilities, that includes consumer staples. It's the thing. Companies selling goods that people will buy in any case, like toothpaste and soap, food and beverages and so on, and maybe healthcare, REITs. Anything interest rate sensitive. I know this might sound counterintuitive, but I think what the market is pricing in here is 4 or 5 or 6 interest rate hikes this year. And I'm highly skeptical whether the Fed will actually pull through with all of them. Yes, there will be an increase in March, maybe another one, and then we'll see what happens. Therefore, I would think that maybe interest rates are not going as high ultimately as the market is currently expecting. That would also open an opportunity in long-dated treasury bonds, which yield is about 1.9%. We don't think it's going to go to 3% like some people seem to be expecting, because inflation is more likely to come down in the latter part of the year. So I would keep an eye on US treasury bonds, a long-dated one, a 10-year bond, I think looks pretty good here as well.
Right. And simultaneously, how are you expecting the US dollar to move from here on? Because a rising US dollar somewhere will be some kind of a risk, especially for emerging markets who do have higher debt in foreign denomination.
Well, given the current environment, I think the dollar should remain strong, just given the fact that the Fed will have a tighter monetary policy than everybody else. The dollar should be strong against the euro. Europe is behind the curve in that sense, that they're not willing to increase rates anytime soon, or at least they will be slower than the US. And I think also against commodity currencies, the US dollar, like against Aussie dollar or New Zealand dollar, should actually look pretty good. Also, maybe not against the yen or the Swiss franc, because these are currencies which are regarded safe havens. But I will continue to see the dollar strong. And of course, that is headwinds for the emerging market space.
Right. So overall, when you're talking about emerging market central banks right now and taking cues from the Fed, do you think emerging market central banks will continue to then remain hawkish?
Well, it depends. I mean, with the they have already started to raise interest rates, with the exception of China. China is a big emerging market, and they are more likely going the other way, cutting rates further because they see that inflation is really coming down, so they can afford to cut rates. So we have a mixed bag there. So I would think that emerging markets they've really done whatever is necessary. What I like about emerging markets is the valuation. Valuations are at a probably 40% discount to the developed markets, and therefore I think there is going to be a buying opportunity at some point, but that would require a return to risk assets, and of course, in the current environment, that could be a few months down the road from here.
Right, and overall, where would you place India in terms of the emerging market gamut?
Well, I think it's right in the mix there. You know, India is in the long run a very attractive emerging market. It has a lot of industries, a lot of stocks to invest in, so that makes it attractive. And there's no doubt that India will continue to grow at a strong pace. So I would think that once the time is right, I think India will be probably should be overweight emerging markets. But as I said, it's probably a bit too early to jump back in.
Right, and overall, you know, clearly the higher growth rates in emerging markets is something which is appealing to investors, and the gap has narrowed as well, because overall, if you go to see the pace of growth in developing and advanced economies, it seems as if that is narrowing as well. So clearly, there is a point of view that an investment in emerging markets is something which might have greater yields than those available in richer countries. So taking that perspective into consideration between emerging and developed, would you place your bets on emerging markets or developed markets right now?
Well, at the moment, I would raise cash in either developed or emerging markets. I would think, as I said, I mean, if you have a very long-term view, you can ride out a bit of volatility. Emerging markets make more sense, as I said, based on valuation grounds. And I think at some point these crises will be gone. I mean, once the Fed realizes that maybe they will not increase rates 6 times this year, and maybe only do 2, or maybe 3, and the dollar starts to go down, I think that would be a tremendous lift for emerging markets. And therefore, I think we're going to get that opportunity. It could be in the middle of this year, maybe in the third quarter or something. But I think in the long run, if you have a 3 to 5 year view, definitely emerging markets should do better.
Right. And overall, if you see in terms of investment opportunities right now, in chronology of importance and higher rewards, how would that be between equity, commodities, debt?
Well, again, let's start with debt. I mentioned high quality debt, like US Treasuries. I think there's a buying opportunity. But if you look at the junk bond space, we still have yield spreads relatively narrow, although they have widened. And by the way, that's something I would look at. For me, the high yield bond market or the junk bond market is a bit of a canary in a coal mine. And over the last few weeks, we have seen yield spreads widening. And that, again, for me, is a signal that equities are at risk as well. So a move, first of all, you have the widening of credit spreads, and then you have to spill over into equity markets. And that's my biggest concern. So when you look at debt, yes, you have to, there's opportunity, but not only in the highest of qualities. Commodities, I would think, should be okay because China seems to be going back on the growth path. I don't think I mean, the deleveraging is pretty much over. They have to cut interest rates. That should increase demand at some point. And when it comes to equities, I would stay defensive for now, but with a view of seeing a buying opportunity probably in the middle of the year.
Right. And when it comes to growth, how are you seeing the growth path for, say, US right now? Because that's something which will be important to watch out for as well.
Absolutely. The economy is slowing already. I mean, as I said, last year we had the tailwind from fiscal and monetary policies. And this year, fiscal and monetary policy becomes a headwind. So I would expect growth to slow down. And as I said, in the second half, we may actually look at recession or a close to recessionary environment, which of course would prompt the Fed to review its policy mix. I would also expect inflation to start coming down. So we are looking at a slowing growth environment in the United States, which of course has impacts on the rest of the world as well. I think that's something which is not quite built into equity prices at this point.
Right. So Hans, my last question coming to you is taking the slow growth into consideration in the US. And if we have to look at India simultaneously, all this while over the last couple of months, we've seen FIs who've been pulling out money from India. Do you think this would be a phase where we will restart seeing, FIs pumping money into the Indian economy?
Well, that's possible, but I think that's a long-term theme. As I said, for this year, I see a lot of adjustment. Again, go back to valuations. I mean, we are at, still nosebleed levels in the United States, way above the long-term average. And if you want to go back to return to the mean, we're talking about a price earnings ratio in the US of 16, now we're at 18, and usually it overshoots on the downside. And if that happens, you will have headwinds for emerging markets as well, regardless of fundamentals. I think the fundamentals in India are actually fine, but the problem is that the psychology, the sentiment, and everything will probably tell us that to wait a little bit with investments in emerging markets, including India.
Absolutely. I think taking the current scenario into consideration, it's more of a watch, wait and watch kind of a mode that you have to be in, and take your bets really in a conservative fashion. Thank you, Hans, so much for joining us on the show. Always a pleasure to get insights. Stay safe. Speak to you soon again.
You too.
Thanks.
Thank you. Okay.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.